Hi, this is Brett Senkis with Senkis Law in Brayton Woods, and today we're talking about 2 ways to market a business for sale. So there are auctions and there are direct negotiated sales. There's an auction process, and then there's a process of going directly to prospective buyers. And those are really the only 2 ways, just generally speaking, that a investment banker or business broker or M&A advisor, which is what we are, those are the 2 ways we think about selling a business, marketing a business for sale. So an auction is a process where we sit down, we scope out a timeline, we create a list of prospective buyers. So this is a business that we're going to go to competitors, usually industry participants or private equity groups that have expressed an interest in this industry. So we're making a list of who would buy this business. We have a timeline. We reach out to them in a very structured process to bring them in, gather interest, bring them into a process. They all know about each other. They know they're going to be bidding against each other. We require that their indications of interest come in at a certain point in time. We require that they review our purchase agreement. It's a one in the auction, it would generally be on the seller's counsel to prepare that agreement, and all the buyers can look at it and kind of mark it up in advance. It's very different than the direct deal. And that's because it's part of the overall package of who we're going to select as a buyer. So we go through this, and there's a number of other things that happen, and the due diligence is very structured, and all these companies, hopefully if you do it right, you've got 3 or 4 or 10 companies all kind of moving through this process. And eventually you choose one to go to the next level, right, and actually knock out the definitive documents. Because even though they've seen a purchase agreement, not everything is fully baked. And sometimes there's reasons, if you've seen my video about 1-step and 2-step closes, there'll be reasons that we're going to sign a deal and there'll be a long period of time in between. But at some point at the end, towards the end of the auction process, you select a prospective buyer and you move down that path. That process is meant to generate a higher purchase price, right? More value to the seller. It's also meant to create a more structured, smoother approach. Whether that's exactly true, I mean, if you've got all those companies coming in, I mean, it can be really messy with due diligence and managing that, but that's where the investment bankers and M&A advisors kind of really earn their money from a project management and shepherding this thing along standpoint. But it is meant to be more structured, more intentional, and again, generate a higher price. So it doesn't work for businesses in Main Street, really. Main Street businesses, we define as less than $2 million. Yeah, it can, but very, very small businesses, if you're selling a deli, there aren't really, competitors don't really, I mean, they might buy a deli, but most deli owners who want to expand are probably going to do it organically. Lots of those delis or Subways or franchise systems. They're not going to buy outside the franchise system or kind of take a different model. So it's like your business is going to be marketed directly, and it's going to be marketed to, in a lot of cases, some individual. Maybe someone who came into some money and they just want to buy themselves a job. So this auction approach is generally for larger companies. Doesn't mean they need to be $500 million companies or anything, but generally you're doing it with companies that are at least $5-10 million and up, and you're creating that list of competitors and industry participants who would buy it. There's a big risk to it, even though if you can create that group. So many years ago, we ran an auction. So I was the lawyer on that deal, and there were some investment bankers, and it was a nice little business who were trying to get $35 million, $40 million for this business, and had a lot of history. There were some challenges, but nothing super obvious on the face. I mean, the auction process, I continue to believe, was the right approach, but we moved people through this process, and they kind of fell out as they naturally do, and I think we were left with 3 kind of finalists, if you will, and then they all fell out. Not because we didn't choose one. They all just declined in kind of somewhere in that next step of the process, this is the risk. If you run an auction and you don't get to the point where you choose a buyer who says okay, and you go to the next step. Remember, the deal can still fall out later on, but it's a little bit easier to deal with for a reason I'll explain. But if your process breaks down at that point, you're damaged goods, kind of. I mean, going back to the others and saying, hey, do you want to get back involved? Because you probably cut a bunch of them off at the step where you went to the finalists, right? So you go back to the others and say, do you want to get back involved? They know you didn't get a deal done. I mean, they feel they're concerned about it. What happened? If the deal blows out later on, a month later, there's many other reasons it can be. And I think most buyers are not going to be nearly as concerned about what are the warts we don't see, what's going on. But if your process breaks down and you don't get to the initial finish line of choosing a buyer who says, okay, let's walk the path and get it closed, you really run a risk that you're definitely not from a negotiation standpoint, a strategic point of strength at all. You're kind of coming back around, and buyers are gonna use that against your seller. So that's a risk. You got to really know that your business that there's gonna be strong interest in it for it to work out. If the business and in most Main Street businesses, that's another reason. It's like there just tend to not be tons of buyers for them. And we've got one right now where the M&A advisors, and we do, right out of the gate, have a couple different bidders, and that's awesome, and that's always the goal. And it often turns out to be the case, but you can't take that to the bank on a really small company in the same way you can with a larger one. Other than auctions are direct negotiated deals. You might reach out to people who are likely buyers. You might reach out to competitors. You might reach out to private equity who shows an interest in this industry. You're also almost certainly going to list that business in some sort of a database that investment bankers use or business brokers use. Biz buy sell is the big one in the Main Street part of the market that are available for outside third-party buyers to take a look at, or unknown buyers to take a look at. So you're still casting a very wide net. You're just not running them through this formal auction process. So when they approach you, you're going to have the investment bank or M&A advisor is going to have a very structured process, but it's not putting everyone on the same timeline. It's directly negotiated. And if another buyer comes in, you're going to use that to try and leverage the deal and probably tell both buyers about it, but they're not necessarily on timelines. It's just, again, very differently structured. So what's good about that compared to an auction is the deal can go on as long as you need to go on. If a business is listed for a year, it starts to get its own sort of warts or damaged goods kind of feel to it, if you will. But you're not in this situation where you have this real risk of the process just breaking down and not working. That it's really tough to recover from. And number two, there are some players out there who are not inclined to really be involved in an auction process, or they're turned off by it. They don't want, buyers don't want to be bid against each other and don't like it. Or they might just not be on your timeline and they might otherwise be interested. So generally speaking, you can expect to have a wider range of buyers in a directly negotiated situation. Now, it turns out you'll probably have less people in the end you're talking to, but the world is more open, let's say. So the two main, really the only big categories of ways to market and sell a business for sale. If you have any questions about this stuff from a legal perspective or from an M&A advisor perspective, do not hesitate to reach out. We'd love to help you out. So thank you for listening today.